Inheritance tax planning often begins later than it should. Most families do not start thinking seriously about inheritance tax until the estate has already grown large enough for it to matter. When the first parent dies, inheritance tax usually is not triggered because assets pass to the surviving spouse under the spousal exemption. At that stage, everything can appear unchanged. The family home remains in place, savings accounts stay under the surviving partner's ownership, and investments continue growing. Life often continues normally for many years. Why the issue appears later? It is usually only later, when the second parent dies or when retirement planning begins, that the full value of the estate becomes clear. By that point, the combined assets may have reached a level where inheritance tax becomes unavoidable, unless planning has already taken place. This is why advisors often say inheritance tax planning is less about quick decisions and more about organizing finances over time. The earlier families understand how their estate is structured, the more flexibility they usually have. Lifetime gifting. One of the most common ways states gradually reduce in value for inheritance tax purposes is through lifetime gifting. The idea is simple. Assets given away during a person's lifetime may eventually fall outside the taxable state. UK inheritance tax rules allow several types of gifts, including annual financial gifts within HMRC allowances, contributions towards weddings, and larger transfers that fall outside the state after a certain period. Many families make these transfers naturally when helping children buy homes or supporting grandchildren's education. When done carefully and early enough, these gifts can gradually reduce inheritance tax exposure. Timing is important because gifts made late in life may still be included in the state for tax purposes. Trust and estate planning. Trusts are another tool sometimes used in inheritance tax planning. A trust is a legal arrangement where trustees hold assets for the benefit of beneficiaries, allowing families to control how and when those assets are distributed. Parents sometimes use trusts to help protect wealth for future generations. However, modern trusts operate under clearer rules than in the past. They can involve HMRC reporting, tax considerations during the trust's lifetime, and ongoing administrative responsibilities. For this reason, trusts are usually used selectively rather than automatically. The importance of property. For many households in London, the largest asset within the state is the family home. Property values have increased significantly over the years, often faster than inheritance tax thresholds. As a result, a house purchased decades ago may now represent a large share of the state's value. To address this in the UK, it has introduced the residence nil rate ban, which allows families to pass their main home to direct descendants while benefiting from an additional tax allowance. However, the way property is structured in a will can affect whether these allowances apply. business ownership, and tax relief. Families who own businesses may face a different inheritance tax situation. Under certain conditions, business property relief allows qualifying business assets to pass to beneficiaries without inheritance tax. The relief was designed to prevent family businesses from having to sell assets simply to pay tax. Whether it applies depends on factors such as the type of business activity, how long the assets have been owned, and the company structure. Inheritance tax and financial planning. Today, inheritance tax planning is closely linked with broader financial planning. Decisions about property ownership, investments, pensions, and retirement income can all affect the value of an estate over time. Helping children financially earlier in life, for example, may support their goals while also gradually reducing the taxable estate. In this way, inheritance tax planning is often less about one specific strategy and more about making financial decisions that align with long term family goals. Inheritance tax rarely appears suddenly. More often, it develops gradually as asset values increase over time. Many families only begin discussing it after a financial change, such as retirement, buying another property, or selling a business. But planning tends to work best when it happens gradually rather than urgently. Understanding the structure of an estate early can make it easier to pass assets to the next generation in a clear and organized way. And in many cases, the greatest benefit of inheritance tax planning is simply clarity. Please contact Taxaccolega Chartered Accountants for inheritance tax opportunities you may be otherwise losing. Thank you.